Okay, so we're going to pick up where we left off in class on Monday. I'm going to back up a few just to make sure everybody had taken good notes. So, number 15, the primary emphasis in most tests of details of balances is on the balance sheet accounts. Remember, in your case study, we're looking at all balance sheet accounts. When you're looking at cash, the accounts receivable, inventory, you're going to do fixed assets. We're going to look at accounts payable. These are all balance sheet accounts, and what we talked about is how inherently you are still testing the income statement accounts because things flow through the income statement. For instance, cash, every payment that you're making, which is part of the expense process, is affecting cash. So in theory, when you're saying it was a valid cash transaction, that has to do with expenses or even revenue with the money coming in. Also, when you're looking at accounts receivable, how tightly that's linked to sales, inventory, tightly linked to the cost of goods sold, and so on. So you can see that our focus on the audit is on the balance sheet areas, but we are still testing the income statement. So number 17, many auditors perform extensive analytical procedures on the audit because they indicate areas of potential risk and misstatement. This is why analytical procedures will help you to identify these risks or misstatements pretty quickly when you're going through the analytical process. This is how I'm going to do it. I just kind of scroll up. Hopefully you can stay with me. We have number 18. When controls are deemed ineffective, the assessed control risk is at the maximum for private companies. So you've got to get this down, okay? When you have control risk, when control risk is set at the max, you cannot rely on the controls. You cannot place emphasis on the controls. You can't use them towards your testing. Most of the time, you will actually see a control risk set at max, ironically, because you're not doing control procedures. You're not testing controls, so you're not actually relying on the controls. You'll still do the walkthrough and understand the control environment, but you're not relying on the controls. So you would set them at max because you're just not relying on them. Doesn't necessarily mean something is wrong with them. You're just not relying on them. When you set control risk at low, this means you are relying on the test of controls. Therefore, you have to do a test of control audit over that particular area. Remember, when you're assessing risk, it's on each of these balance sheet areas. Hopefully that makes sense. If it doesn't, please let me know because that's an important takeaway. Number 20, list each of the 5 types of audit tests and give at least 2 types of evidence that may be obtained for each type. So you can read through those: risk assessment procedures, test of controls, substantive test, analytical procedures, test of details. The risk assessment procedures are generally part of your planning process. Test of controls start to get integrated with your substantive testing, but you've got your substantive testing, analytical procedures, and test of details. So those are the areas that you'd be auditing. So at number 20, describe the 5 types of audit tests. Identify which of the 5 types are substantive tests and which are used to reduce assessed control risk. 5 types of audit tests used to determine whether financial statements are fairly stated are the risk assessment process, like we've talked about, the test of controls, substantive testing, the analytical procedures, test of details, just like we saw in the one before. Substantive tests of transactions, analytical procedures, and tests of details, those are your substantive tests, whereas procedures to obtain an understanding of the internal controls and test of controls are used to reduce assessed control risk. Number 22, describe the purpose of substantive tests, test of controls, test of details. Give an example of each. So read through those, but the substantive test of transactions and the test of detailed balances are really testing the balance sheet accounts. when you're looking at the test of controls, that's clearly looking at the control environment. But read through this and you'll have more detail there. Number 23, there are 3 stages of the audit in which analytical procedures are performed. We've talked about this a lot. You should be very comfortable with when analytical procedures are performed. So number 2, an exception or deficiency found in a test of controls indicates the likelihood of misstatement. So if you're doing these control tests and you find a misstatement, that is, you're not actually going to find the misstatement. You're going to see that there's lack of control, which therefore could lead to a misstatement. Which of the following audit tests is usually the least costly to perform? Again, we've talked about this a lot, analytical procedures. An increased extent of test of controls is most likely to occur when controls are effective and the preliminary control risk is set at low. Number 9, the reliance the auditor places on substantive tests in relation to the reliance placed on internal controls varies in a relationship that is ordinarily inverse. So when you have your substantive tests, so the audits that you're doing are substantive tests, and then you have internal controls, there's an inverse relationship. So the more test of controls that you do, so the more reliance on the internal controls, the less substantive tests you're going to do. And then the less internal control work that you do, the more substantive testing you're going to do. So you can see that inverse relationship. So number 11, which of the following is not a valid basis for omitting an audit test informing an opinion on the client financial statements? A, the difficulty and expense involved in testing a particular item. So you can't just not test something because it costs too much or it's difficult to perform. You can think about alternatives. So when I keep saying, you are looking for the most efficient way to do your testing, whether through test of controls or substantive testing, but you can't hang your hat on things costing too much. If that's what you need in order to place reliance on a number, then you need to do the testing. Number 13, test of controls are generally more costly to perform than analytical procedures. That's correct. Test of controls are extremely costly to do, which is why a lot of companies, for the non-public companies, they're not just going to do a test of control audit just because. That's the most costly type of testing to do. They resort to the substantive audit testing where you can just test the balance at the end of the year instead of all of these control transactions throughout the year. Number 14, the only test of details of balances involve physical examination and confirmation. So yes, when you're testing a detail of balance, this is when you're getting to the physical examination of things, so your inventory observations and your confirmations that you send out. Mm-hmm. All right, so number 1, auditors who test manual controls that rely on IT-generated reports must consider both the effectiveness of management's review and the automated controls over the accuracy of information in the report. So for this, with the IT, you can't just get a report and assume that it foots. Let's say you get a 60,000 page inventory report and you just look at the total of the report. Clearly, you're not going to sit there and calculate, 60,000 pages or lines of inventory. And let's say it's not in Excel, so you can't do a quick Excel sheet. It's a hard copy that they printed out from their system. You're not going to sit there and add it. That's going to take a day to do. You're going to rely on the IT controls to say that they have a system that properly calculates the report in total. It does all the extensions that you did by hand in inventory, so you can rely on those controls. So letter B, automated controls over the accuracy of information in the report. So again, you have to make sure that those controls are in place and that management's reviewing the controls over the IT structure. So this is for every single report that could be generated from a system. When you're getting sales journals, cash receipts journals, all of these are coming from a system, and you're relying on the information that's going into the system and what's going on internally in the system. Number 3, in the audit of a public company, automated controls must be tested if they are considered to be key controls for reducing the likelihood of material misstatements in the financial statements. You still have to do testing on these automated controls. Number 1, the document that details the specific audit procedures for each type of audit is the audit program. That's what you've been putting together, these audit programs. Now remember, that's going to be the document that identifies all of the audit procedures, right? So you have your audit program, and within your audit program, you have all of your audit procedures. Number 3, when designing the audit program and the particular audit test, the auditor should keep in mind that analytical procedures performed during substantive testing are generally more focused and more extensive than those done as part of planning. So what this is saying is, if you're going to use analytical procedures as a substantive test, you have to do a lot more testing. So let's say you're trying to test a whole balance of, you're looking from year to year why something increased. And maybe during planning, you're just sitting with the client saying, why did this increase? And they said, let's say inventory. We'll stick with inventory. Inventory has increased because we didn't sell as much this year. We purchased more than we actually sold, so the inventory on the balance sheet is higher. That would be sufficient for planning purposes. During year-end purposes, if you're going to use analytics for substantive procedures, you will need to get into calculating your inventory turnover ratios, your days on hand of inventory. You'd look more in detail, taking a sample of purchases that have come in during the year to really justify that comment of why the inventory is higher, that they purchased more and sales were lower. Sales, you'll be able to clearly see on the income statement that they've been lower. But more purchases, you'd probably want to do some sample testing to substantiate your analytics as a substantive audit procedure test. So again, if you're going to rely on analytics for a substantive test, inquiry alone is not enough. You have to back it up with some additional testing, sample sizes, some type of documentation. Now discuss the relationship of each of the following to the extent of plan, test of details of balance. So we've got tolerable misstatement, inherent risk, control risk, acceptable audit risk. So inherent risk and control risk are directly related to the extent of plan, test of details. Those were the ones that we saw during the planning. So inherent risk, that is inherent or control risk, increases the extent of plan, test of balance is also increased. Tolerable misstatement and acceptable audit risk are inversely related to the extent of the plan detail. So if tolerable misstatement or acceptable audit risk increases, the plan detail decreases. So what this is saying is if you increase your tolerable misstatement, this is like your materiality. If you say originally it was $5,000 and it goes up to $10,000, that means that you're willing to accept more misstatement. So if you're willing to accept more misstatement, then you're going to do less testing. Same is true for the acceptable audit risk. If you are going to accept a certain risk in the audit, let's say, you say, okay, we'll accept a 5% audit risk when you do all of your statistical procedures, which we really didn't get heavily into this class because it is a very high level, but when you come up with what you think your percent is for acceptable audit risk, let's say 5% risk you're willing to take, that something's wrong in the numbers. If you increase that risk to 10%, then you don't have to do as much testing because you're willing to accept more of a risk. So maybe your sample sizes are smaller, whatever the case may be. When you're accepting more risk in the audit through tolerable misstatement and acceptable audit risk, the amount of testing that you're doing decreases. Number 10, auditors must use considerable professional judgment to determine any change in audit procedures that can be made when a level of inherent risk is increased or decreased. So this is true. I mean, they have to use considerable judgment really at any time throughout the audit when they're trying to determine these things. So which of the following types of procedures will be performed in an audit of internal controls over financial statements? You have to obtain an understanding of the internal controls, right? This is what you did. The planning section, you were understanding what was going on from a control environment standpoint. But remember, in your planning, you did not do any ratio analysis. This is not the time to be performing ratios or analytics or anything when you're doing an audit of internal controls. The main purpose is that you understand the internal control environment, and then you get into the specific testing of those controls. So if somebody says every time they ship something, they're matching it to the sales order to say that it's a true sale exists, so this is what's going to justify us shipping it out, and then somebody signs off in that review that they've done this matching, that's a control that you're looking to see a sign off that somebody has matched the sales order to the shipping documentation. Presentation and disclosure related audit objectives will be performed in which phase of the audit process? This is at the completion phase. Right? So when you're actually going to put together the financial statement package and disclosures, it would be at the completion. When the auditor has completed the test of details, balances and enters into phase 4 of the audit procedure, she must still perform audit procedures for which of the following? So phase 4 is the completion. So these contingent liabilities and subsequent events. Contingent liabilities are mainly when you have legal proceedings are the big contingent liabilities that are out there. So if a lawsuit is going on, is there some type of contingent liability that is also out there? So, this is a tricky one from a disclosure standpoint because you don't want to say our client's expecting to lose the case, so we're going to disclose a $500,000 liability because then that's showing hands to the other lawyers when the case hasn't been closed yet. But you do have to disclose, these potential contingent liabilities. And then subsequent events, we've talked about this, where if you're performing your audit on a 12/31 balance sheet date, and you're out doing your field work in January and then issue the report in February, you're on the hook for anything that has happened from December 31st to the time that you actually issue your audit report. So any types of mergers, acquisitions, sales, legal suits, significant product line changes, extraordinary activities, discontinued operations, all of those things would be considered for subsequent event activity. And if something did happen from the balance sheet date to the date of your actual report date, you have to disclose that. Okay, we're on the final stretch here. Number 7, which of the following audit tests would be regarded as a test of controls? The test of the signatures on canceled checks to board of directors authorizations, right? So signatures, those types of things would be a test of control. So when you're doing your test of controls, you're actually looking at those signatures. Which of the following ultimately determines the specific audit procedures necessary to provide an independent audit with a reasonable basis for the expression of an opinion? Again, it's auditor's judgment. All of these things that I've been talking about, it is judgmental. What is your sample size going to be? How many confirmations are you going to send out? How many recalculations are you going to perform? How many inventory counts are you going to do? How many things are we going to trace to a cutoff statement on the cash bank statement? So on and so forth. This is judgment, and this is not something that a first-year staff person would determine. It would be the manager that's coming up with these samples, or possibly senior, but it's something that can't be taught, this judgment. It comes with time. in practice. Okay, so then we have the final one, discuss the major activities and procedures performed by the auditor in the plan and design of the audit approach. So these should start feeling familiar to you. You're accepting the client, you're understanding their industry, you're assessing their risk, you're performing preliminary analytics, you're setting materiality, you're understanding the internal controls, you're assessing fraud, and then you're developing the audit plan and audit programs. So that's it for this audit plan and program chapter.